On the 14th of June, President Trump announced that a deal has been reached to extend the ceasefire and reopen the Strait of Hormuz. Now, this news has been confirmed by Iran's Deputy Foreign Minister, as well as by Pakistan and Qatar, the mediators in these negotiations. An official signing ceremony is expected to be held this Friday in Switzerland. While President Trump has announced similar deals in the past, confirmation from Iran and the mediators increases the likelihood that this agreement will proceed as planned. What does that mean for the global economy and for investors? Hi, welcome to On Investors' Minds. I'm Tai Hui, the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management, and thank you for giving us a few minutes of your time to understand what investors are thinking about right now and how that fits in with building the right portfolio. So, the details of this agreement remains quite limited at this point, and the situation can still change even after the MOU or Memorandum of Understanding is signed. Also, this is not likely to be the end of negotiations, as a durable consensus on Iran's nuclear program and easing tensions among Gulf countries could be difficult to achieve in a sustainable way. Moreover, there have been sporadic military actions from both sides since the initial ceasefire was reached in early April. The conflict between Israel and Hezbollah in Lebanon also remains a wildcard for this peace process. Nonetheless, the agreement to reopen the Strait of Hormuz would be the most relevant part for investors. So let's start with talking about what does that mean for the global economy. Reopening the strait is clearly a positive for the global economy, as disruptions in energy and petrochemical supplies can introduce stagflation risks. While markets may be quick to price in recovery, a return to normalization could take some time. The first hurdle will be convincing insurance companies and shipping companies that it is safe for vessels to transit through the Strait of Hormuz. Even with a reopening, the insurance premium for ships passing through the strait could still remain elevated, increasing the cost of oil, gas, and other products from the region. Also, it will take time for energy production, refining, logistic capacity to return to pre-war levels. A reasonable estimate for normalization is several weeks, if not 2 to 3 months. This does not account for production facilities that may have been damaged by Iranian attacks. Some could take 2 to 3 years to repair and bring back online. Countries and governments may also seek to replenish inventories and strategic reserves in case the situation in the region deteriorates once again. Overall, this suggests that energy prices are not likely to fall back to pre-war levels in the near term. For central banks, reopening the strait should provide some relief, as the initial inflation shock from energy prices may not yet have fully filtered through to inflation expectations. This will allow the U.S. Federal Reserve to hold its policy rates unchanged this week and continue monitoring. The European Central Bank raised policy rates last week, and it was already on a tightening path ahead of the conflict due to building inflation pressures. If energy prices calm on a sustained basis, this should give the ECB more flexibility to adjust policy rates later in the year. What does that mean for investors? Unsurprisingly, the immediate market reaction is a risk-on rally. This could prompt further rotation, benefiting recent laggards. Non-tech sectors may play catch-up if a major source of economic uncertainties is receding. Consumption-related companies, energy-intensive industries, and transportation sectors could benefit. In Asia, ASEAN and India have seen performance hindered by energy shortages and inflation pressures. An eventual resumption of energy imports should help to support these markets. This also opens a window for investors to diversify away from technology, which has already performed very well year to date. This type of rotation calls for active management in equity allocation. The prospect of peaking policy rates could also support adding duration in selected government bond markets, as well as a modest tightening of credit spreads. Improved risk appetite could also renew pressure on the US dollar. Now, beyond the immediate market reaction to a deal and the reopening of the strait, investors may have questions about the long-term implications from this conflict. Today, we can briefly discuss on 2 areas. Number 1, energy security is once again at the top of the agenda. The Russia-Ukraine war forced European governments to reassess energy dependence. Meanwhile, the conflict in the Middle East has had an impact on Asian economies. An important question is going to be where they import oil and gas going forward. And this also raises a question about energy sources and the role of non-fossil fuels, including renewables and nuclear power, and that could also extend into energy storage and electric vehicles. Second, the U.S. Iran conflict suggests that the scale of defense spending is not the only factor influencing outcomes, but also how that money is spent. High-volume, low-cost weapons such as drones gave Iran an advantage in controlling the Strait of Hormuz and threatening other Gulf states to gain leverage. The economics of defense is also likely to evolve in coming years, potentially driving another rotation within the defense industry. Thanks for listening. If you enjoyed this podcast, please share this with your friends and colleagues, and of course, consider subscribing. If you have any follow-up questions, please reach out to your JP Morgan Asset Management client advisors. I'm Tai Hui. I'll see you in our next episode to discuss what's on investors' minds. Meanwhile, stay informed and stay invested.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase & Company and its affiliates worldwide.